Nicholas Bornolis of Capital Link, and I would like to welcome you to this new session. This session is going to discuss alternative income generation strategies. We will talk about REITs, real estate interval funds, preferreds, and convertibles. So I would like to thank Svitlana, Barry, and Collin for being with us, and of course, John Duggan from Morgan Stanley, who is going to moderate the panel. We have a great group of panelists, great moderator, and a very interesting topic, especially in today's investment environment. And with that, I will turn it over to John.
Nicholas, and thank you all for taking part in our panel today and viewing. As Nicholas mentioned, it is the Alternative Income Generation Strategies panel. And the members of that panel are Svitlana Gubriy, Head of Global REIT Funds at Aberdeen Standard Investments, Barry Nelson, Senior Advisor at Advent Capital Management, and Collin Bell, Global Head of Client Portfolio Management for Fundamental Equity at Goldman Sachs Equity Management. Pardon me, Goldman Sachs Asset. I think one thing we can agree on this year is there's been a lot of conversation, almost dominant among all sorts of investors, about growth versus value. But surprisingly, a little bit left out of that conversation, I believe, has been income, dividend income, I should say. And depending, many of them are lagging tremendously the broader markets, and in some cases, down on the year. In a world where we've had a tremendous rebound, coupled with a renewed search for yield, this, I think, is truly surprising. And our panelists are going to shed some light on what we may be missing from the equation in terms of dividend income sectors like real estate and REITs. We're also going to look at hybrid spaces like convertibles and have some discussion on what the opportunities are for the balance of 2020 and into 2021 on that sector. And with that, I'd like to turn it over right away to Svitlana for some comments.
Thank you, John. Good morning, good afternoon, everyone. My name is Svitlana Gubriy, and I'm heading Global REIT Funds at Aberdeen Standard Investments. I'm based in Edinburgh, so it's actually quite getting late. Actually, not 4 o'clock in the afternoon. Aberdeen Standard Investments is the second largest real estate asset manager in Europe. And with global presence, we have offices in 17 cities around the world, and we manage around 50 billion AUM in real estate across direct real estate, listed real estate multi-manager, and real estate debt. Our team manages a number of listed real estate funds, global funds, regional funds, European, US, ex-US, and one of the funds that we manage is a closed-end fund listed in New York Stock Exchange, Aberdeen Global Premier Properties. This fund invests in listed real estate companies, REITs around the world. We are a truly global fund. The fund is benchmarked against FTSE EPRA Nareit Global Index. So at least theoretically, we have an ability to invest in some of the emerging markets. And historically, we've been quite active in those markets. But in today's world, looking at risk-reward opportunities, we do see a lot of opportunities on the income side. So typically for our investors, we are targeting higher income profile companies, but we also use a barbell approach. So we mirror that with more growth focused names. So if you look at our portfolio today, we take a very active approach to the management. We underweight the sectors, and we've been underweight the sectors that face a lot of structural challenges, for example, retail. And geographically, we underweight markets where we have concerns about longer term real estate fundamentals. Hong Kong is being one of them. On the flip side, the fund has overweight positions in infrastructure real estate names that we believe will continue to grow in the future beyond pandemic, sectors that are new to the markets, for example, newer sectors such as self-storage or student accommodation in Europe. In the US, it's a very well established sector, but in Europe, it's still up and coming. We also pay a lot of attention to the new and off-benchmark opportunities in Asia Pacific that allows us again to balance income and growth in the fund. We cannot not mention the current global pandemic and the impact on real estate, and I'm sure we will talk about this a lot today. But the way we look at that, everything that we expected to happen in real estate for the next 5 years effectively started to happen in the last 3 months. So this situation accelerated structural changes that we were expecting. And going forward, there will be some opportunities, but at the same time, it will be interesting to see how the new interest rate environment and how search for yield and income will change the dynamic in real estate market in particular. And I'm happy to answer questions later on.
Svitlana, did you want to address a little more in depth some of the specific sectors, including potentially those within AWP, and what your first stance is in particular on retail currently?
Retail is a challenge sector, and as you can see from all the negative headlines over the last 6 months, our fund has been underweight retail for quite some time. So technically, we actually haven't done any changes to our retail allocations since March because we were already underweight. Right now, there is an interesting debate. What kind of retail will survive? What kind of retail will be robust? And when is going to be the time to buy retail? Because our expectation is that investors and valuations will overshoot. And there will be some value opportunities, but we're not there yet, and not all retail will be there. And I'm sure Collin will can expand on this topic as well. But basically, what we always knew that with retail, you need to be very careful. You need to be always thinking about matching the right retail offering and the catchment area, the right tenant mix, and ability of that tenant mix to pay rent. Because for us, it's at the end of the day, this is the dividend that those companies, those landlords will be able to pay out to the shareholders, to us.
Great. Also, Svitlana, realizing that some of your portfolios are quite global, often with a base of close to 50% United States, with the remaining allocation spread around countries, often including Germany, Japan, to some extent China. Can you give us your view in a quick manner on some of those larger countries that tend to be included with your portfolios along with the US?
Absolutely. One of the interesting trends that we're seeing in the market, even though real estate is a local investment market, but the trends are becoming more and more global. So for going back to retail, what we started seeing in the US in the retail space 3 years ago, 4 years ago, it was the first sign of weakness in that sector. Even 12 months ago, when you talk to some of the Australian investors and Australian companies, there was a view that Australia is different and retail environment in Australia will be different. But guess what? 12 months fast forward, they are exactly in the same situation, even pre-COVID. Similar story with residential market, with apartments, rental apartment market. Even though different countries have different regulations and rent controls and building regulations, you still see similar trends in terms of the defensiveness of that sector. And especially this year, investors became very acute to the point that residential is a defensive sector. And as a result, German residential names, Finnish residential names performed extremely well, and that allows us to get exposure to that defensive element. Another interesting market in terms of residential, rental residential, is Japan. Historically, Japan didn't have very attractive growth in the residential sector. However, demographic changes and economic changes led to unprecedented growth in that market. And even today, despite economic slowdown due to COVID, we're still seeing attractive rental growth and limited supply. And we as an investor can invest in that market by buying Japanese REITs focusing on residential market. So when we think about our global exposure, there are a lot of common themes. So we will be overweight in defensive residential, overseas, not in the US. We are overweight industrial names across the board. Every single region has very strong demand for industrial, and it's not only e-commerce, it's also supply chain reconfiguration and the switch from just-in-time supply to just-in-case supply, which leads to very large volumes of demand for high-quality industrial space. So for us, this is the opportunity for growth, and this is the opportunity for income. That's why from our investor standpoint, this is a very attractive proposition to mix and match income and growth in today's environment.
Great, thank you very much, Svitlana. I'm now going to turn it over to Collin, who will also be addressing real estate and potentially the income theme in general.
Great, thanks, John. Thanks everyone for joining. Just by way of additional background, I sit within Goldman Sachs Asset Management. We manage about 1.7 trillion of assets across equities, fixed income, and alternatives. We've really sought to augment our retail footprint, I'd say, over the past decade, and as part of that, have been very committed to expanding what I'll call our alternative access vehicle platform. So we entered the closed-end fund space in 2013. We launched our first BDC in 2015, and then most recently this year entered the real estate interval fund space. So that's the fund that I'm a PM on, and we'll speak most specifically to. But the objectives of this fund, our Goldman Sachs Real Estate Diversified Income Fund, is to deliver an attractive yield, which is currently about 6.3% using the last distribution and annualizing it, and to deliver low vol and low correlation on top of that. And we do it by investing in all forms of real estate, not just equity, but also debt, and not just listed real estate, but also private. And part of the reason we really like the interval fund structure is it allows us precisely to do that. We're big believers in this structure. It's very akin to an open-ended 40 Act fund in the sense that it's daily priced and you can make daily purchases. The one nuance is we have the ability to restrict redemptions to a predefined interval, in the case of our fund quarterly, and that allows us to provide a whole host of benefits to retail investors, one of which is to provide access to private illiquid investments, in our case private real estate. And it doesn't come with all the headaches and challenges that come with a traditional private investment. You don't have high minimums. You don't have to be a qualified purchaser. There are no reporting headaches. Everything is through 1099, et cetera. So we're really big believers in this structure and really believe this structure makes a ton of sense in the world of real estate. And just extending on Svitlana's comments that I think really well summarized, the backdrop in real estate. I would say overall, and John, just your opening comments, I think sum it up quite well too, which is it's quite a head scratcher in that if you take a step back and really look at the challenges in the markets today, it's one of just muted growth, and it's one of muted yield, right? We have a growth problem and we have a yield problem. And as a consequence of the growth scarcity problem, growth has massively outperformed, but you certainly haven't seen income, at least on the equity side, outperform as you would expect in a sort of income scarcity backdrop that's been exacerbated by all the stimulus that's been put into the market on top of dividend cuts that we've seen in the equity market. And, I really think the only explanation for it is a couple of things. I think it's a fear around dividend cuts that indeed have been real, that have exacerbated the yield scarcity problem. But as we'll talk about, we think that's very much in the rearview mirror. I think the other reason is just the affiliation with the value side of the market that's clearly been, out of favor. The S&P 500 is up 7% year to date, but the value side of the market is actually down 11% versus the growth side of the market up 24%, which is quite extraordinary. So this backdrop, I think, is a good backdrop to contextualize as we talk about real estate, because I think real estate's a very similar story in that, it's been painted with a very broad brush and generally has been cast in a fairly negative light. And, that's why in aggregate, when you look at listed real estate equities, they're down about 15% year to date. And I think while indeed, in our opinion, they should be down, there's no doubt there have been some negative impacts from the pandemic, in a world which is aggressively transitioned from the physical to the digital, with real estate very much representing the physical. That has had a negative consequence on demand, and it's been particularly pronounced in hotels, retail, and office. But the reality is the impact of this pandemic and the impact of real estate broadly wildly varies by property type. And I think Svitlana, hit on a lot of these points, but there's no doubt that we're in a backdrop of accelerated disruption that's becoming more pronounced, more accelerated, more pervasive than ever. And real estate is no exception to that. And so, long-winded way of saying, we think that there's a very compelling case for real estate in general, in the sense that you get a 3.8% yield in the US, I'm talking equities here only. Obviously on the credit side, much higher than that. Perhaps your preferred credit, you're looking at 6-7% type of yields. So you get good yield with companies that have payout ratios at about 78%, which is actually much lower than what we've seen in the global financial crisis. So arguably, safer yields. You still can get growth. You've got, companies that are generally better capitalized than they were versus the global financial crisis. And you're looking at valuations where they're screening cheap on every metric, versus bonds, versus equities, versus the private market. So we think the setup for real estate is quite good, but the best way to capture this opportunity is really, in our opinion, you have to go active, and you really, really have to cast a wide net to exploit the opportunity that we now have. And really what we've been sharpening our pencil around is, with respect to the property types that really have been hit hard, what are the ones that arguably are secular losers versus where the demand driver arguably has only been temporarily impaired and will improve as we get a vaccine. So, on the, retail, obviously I think is the best example of just a secular loser. We didn't like retail going into the pandemic. We like it even less post-pandemic. I'm sure people are familiar with the trends and the bankruptcies happening, notably in the US, Lord & Taylor, JCPenney, Neiman Marcus, J. Crew, Brooks Brothers, GNC, you name it. There's been a ton, and it's all on the back of just its acceleration of online spending and penetration percentage of online sales has really trended over the past decade at about 100 to 150 basis point increases. But this year it's been accelerated to be about 450 basis points. Online sales in general are about up 30% year to date. When you look at the big retails, like Target and Walmart and companies like that, their online sales, Lowe's, their online sales are up 100, 200% year to date. So that's wreaking havoc on bricks and mortar retail. That's just translating to less demand for bricks and mortar retail, and we think that trend is only going to continue. I would agree with Svitlana that there's still opportunity. You just need to stock pick your way there within the world of real estate, and clearly, shopping centers that have tenants that cater to experiential or necessity-based shopping is going to do better than the malls and the apparel retailers that are hurting much more so. But generally, we don't like that sector. But that's a secular loser that we're heavily underweight. We have very little exposure in our fund to retail, sub 3%, which is quite small. Conversely, I would say sectors like senior housing has been hit really hard year to date, and retail's down about, I want to say 45%. Senior housing is down probably about 35%, and that's really been hit hard because if you think about senior housing, the tenants for senior housing are the highest at risk part of the population. That's really been in the eye of the storm of the pandemic. That hasn't obviously translated to strong demand for new occupancy in that part of the market. But as we look forward and as we look into the post-vaccine world, we actually think the demand driver very much remains intact. In fact, will accelerate as we have aging demographics helping to fuel that. So that's really what we're focusing on is the down and out sectors, and really trying to determine again if it's a secular loser versus something that's been temporarily impaired. And then, on the other end of the spectrum, look, real estate ultimately houses the economy, the old economy and the new economy. And there's so many property types that really are not only relatively unimpacted by the pandemic, but in fact are benefiting. So towers and digital storage companies, these are, think about proliferation of data trend that's happening on the back of the Zoom call and all the online learning that our kids are having to do, and the media that we're streaming, and the push towards 5G and the Internet of Things, that all that stuff is creating a massive proliferation of data. And the real beneficiaries of that in the real estate context are those that transport it, that are the tower companies, and those that store it, which are the digital storage companies that in essence house the cloud. Those companies, in fact, have done quite well year to date. Data centers up 25%, towers up 13%. Industrial REITs, these guys are on the right side of the Amazon trade. These are the guys building the logistics to get that box from the warehouse to the end consumer, that are benefiting from all the carnage that's happening to bricks and mortar retail. And then it has this added tailwind of companies to increase desire to domesticate supply chains, in a post-COVID world. So that sector is doing quite well. Life science office space really benefiting from innovation trends. The tenants here are the biotech companies that clearly where innovation has only accelerated post-pandemic. So there are a lot of places in the market that we had, in fact, are more constructive on fundamentals post-pandemic than pre-pandemic. And then there are certain sectors that kind of sit in the middle that we think will do just fine, particularly in the world of housing that's quite expansive. And in the listed market, there's so much interesting stuff that we can invest in. It's not just a debate around for sale versus for rent, but within the for rent market, we can invest in multifamily properties, we can invest in single family rental properties, we can invest in manufactured housing, and all this have different demand drivers and have been differently impacted by the pandemic. But manufactured housing, single family rental actually have benefited from the pandemic's backdrop. Single family housing due to the transition from the city to the suburbs, manufactured housing due to the either the desire or being forced into lower cost forms of housing. And within the multifamily space, and this is consistent with the office space too, You know, not only are we having a trend of sort of pushing from the city to the suburbs, and in the case of office, the trend around telecommuting, that's arguably a secular headwind for office. But really, we still think there are ways to win here, and the ways to win are to focus in, you know, states that have lower taxes and are generally in warmer climates where these companies are relocating, and consequently these people are relocating. So there's ways to win still in office, and also as a corollary to that in multifamily that we're really excited about. And then just the last comment I'll make, I know we're running up against time, is just a comment on listed versus private. You know, it's quite a hot topic in our industry around, you know, the listed guys will say private is too expensive and too opaque. The listed guy, or the private guys will say listed is too volatile and too equity-like. We don't think it should be one or the other. We think the best form of implementation of the world of real estate is a mix of the two. They've become increasingly more and more complementary with each other in terms of how they in terms of underlying asset exposures. And one of the real big changes we've seen that's been particularly pronounced here in the U.S. is the magnitude of non-core property types. So all the stuff that sits outside of office, industrial, multifamily, and retail, things like towers, digital storage, life science, office, manufactured housing, a lot of that stuff that's on the right side of disruption that I described before. The percentage of non-core in the listed US REIT market was 10% 10 years ago, and today that percentage is 46%. The percentage of non-core property types in the Odyssey Index that represents core private real estate is 0%, right? And so they've become increasingly more complementary, and so we love that as we look to put the pieces of the puzzle together to create complementary exposures as opposed to overlapping. And also because listed trades differently versus private. You know, listed is part of the forward-looking discount mechanism of the stock market. It's priced real time, and therefore things price in more quickly, right? And that allows us to arbitrage mispricings that happen between listed and private. And you saw it in Q1 with listed down 27% and private up 1%, which is quite a head scratcher. But if you have a fund that's investing in both, that creates a really interesting opportunity to arbitrage that temporary disconnect, which we can do in this fund. So I apologize, I talked quite extensively there, but I'll stop there. John, pass it back to you.
Thank you very much, Collin. And now we're going to turn it over to Barry for a discussion on the convertible side.
Good morning, everyone. Barry Nelson, Advent Capital. We manage convertible securities. Advent Convertible and Income Fund, ticker AVK. I've been around convertibles since 1973, and I was one of the creators of AVK in 2003. It took me 30 years to figure out there was a need for such a closed-end fund. AVK gives you exposure to convertibles. We're about 70% in convertibles right now. Convertibles are having a banner year. Convertibles are ahead of the S&P 500. We've had record issuance, and AVK, we've lagged somewhat because we haven't ridden convertibles to the stratosphere in the cases of our hottest company in convertible land has been Tesla, and the convertible bonds rose to 600 or 700% of par. We're long gone. We watched the downside, and that's reflected in our recent performance strength in weak markets. We've done much better than peers in the last few weeks in holding up on the downside. And that's a whole key to convertibles. Convertibles historically capture much more of the upside than they suffer on the downside. And here we are with a pandemic, with divisiveness in the US, social unrest. Oh my God, overseas, that country that Svitlana is sitting in, Brexit, it never ends. They never end with Brexit. They never end the discussion. God knows what's coming. And with convertibles, there's inherent downside protection with participation on the upside. the convertible market traditionally is a growth market. And as Collin alluded to, growth has really been the place to be this year, year to date, and it's shown in convertible sub-indices. And technology is going to be one of our biggest participations in the market. And with so many new issues this year, we have many more investment opportunities in convertible land. It's a great time to be managing convertible securities. And yet, as the Calamos man alluded to in a prior session, convertible closed-end funds have been hammered more than others recently. That the discounts have expanded. AVK is trading at something like a 16% discount from NAV. That's way over our historical discount. And we make monthly distributions, and our distribution yield with the stock at a 16% discount has gone over 10%. We know that retirees love these funds, and we're serving them with convertibles, a niche asset class, a class that individuals cannot really participate in on their own. We're institutional investors, we're convertible specialists, we're in the market every day. And this is an especially timely strategy to be in a convertible strategy and at a discount in a closed-end fund at this time. We also have high yield in the fund, something like 30% right now, and the purpose of that is to boost the yield. Obviously, yields on all asset classes have come down, but we think that high yield is still attractive, and with leverage in the fund, this is a way to create additional net interest income and help keep up the distributions. This is an unusual opportunity at the present time. I can speak for another half hour. But,
Barry, I think one thing people are becoming increasingly concerned about is credit risk, both in high yield and in convertibles. At this point in our economy, when there's still plenty of uncertainty, can you kind of characterize your feelings there?
Well, on the one hand, we are optimistic that there are all sorts of signs that the economy is coming back, and that should be good for credits. And on the convertible side, companies that issue convertibles can often refinance. I mean, we've seen spectacular examples of that this year. Carnival Cruise, their revenues must have gone to zero, and they floated a large convertible bond in April on exceptionally attractive terms, 5.75% coupon, only a 3-year maturity, and only a 25% conversion premium. In other words, $1,000 bond gets us $800 worth of stock. That stock's now worth $1,700. What did Carnival do? They floated a convertible. They also did a high yield bond and an equity offering. They restored their liquidity. They're going to survive until the economic recovery. They're not the only ones that did this. We've seen consumer-oriented companies issue convertibles at very attractive terms. And we're credit analysts. We can separate those that are going to survive from those that may be in danger despite refinancing. That said, convertibles historically have had low default rates, and I think part of it is the ease of refinancing, of tapping the volatility of the equity market by issuing a new convertible.
Great, thank you, Barry. We do have some questions from viewers and participants. Specific one for you, Collin. Can you give us the main reason why you chose an interval format rather than a traditional closed-end fund for your listing of the product you described? And I also have a question for both you and Svitlana, unless we run out of time, because it's kind of a big question. assuming that you both believe most of the bad news has been priced in on REITs and real estate, correct me if I'm wrong, if we were to suddenly get very good news, such as work, can you quantify how much of a quick upsurge on total return we could potentially have on REITs and real estate? But I'll let you address the first part, Collin.
Yeah, sure. So the answer is pretty straightforward. So why interval fund over a traditional closed end? You know, it was largely predicated on our view in this instance, in the world of real estate specifically, that it made sense to do an interval fund, and it was possible to do an interval fund over a closed end fund. As part of that, since it's kind of a closed end fund-ish type of structure, where it's closed end but has a little liquidity on the side, you actually strip out that discount to NAV issue, which I know we think a lot of investors, you know, care about. So we kind of felt like it was the best of both worlds, and well suited for real estate specifically. And I'm sorry, the second question, you broke up, and I'm happy to help answer that, or someone else can answer it too.
Well, this is a very big picture question. Sorry for breaking up. If we were to have exceptionally good news in terms of a vaccine and people returning to work in short order, just how much of a rebound do you all think would potentially happen for REITs and real estate, you know, over the next 3 to 6 months or even sooner? And that's for both you and Svitlana.
Yes, Svitlana, do you want to take a first stab? I felt like I overtook my share of time.
That's all
so
right.
I'll defer to you.
That's all right. I'll try to be brief. So as actually Collin mentioned, real estate investment is a reflection of our economy. So if our economy returns to normal, or whatever the new normal may look like, some of the things will be different. I think trend of going to online education, trend, e-commerce, all of that is here to stay. So I think what we may see is industries that benefited from this change to digitalization, to e-commerce, they will continue to have a very strong backdrop from the economic perspective. But other sectors, hotels, if the travel resumes, offices, if the confidence of office workers improves, all of those elements will help to increase confidence of investors in terms of the dividends capability of the REITs. So we do think that as the economy returns to what it was before, at least to some extent, it will benefit the real estate. But the trends that we were enjoying in some of the sectors recently will continue to be strong even in that environment.
Do you think something like a 20-25% total return rebound is?
I'm always find it difficult to put specific numbers and promise specific return expectations. But if you look at, for example, at discounts that closed-end funds in real estate space trade today versus February, so in general, on average, you will see decline of between 10 and 7%. So if we saying that the market will come back to normal and investors' psychology will be more positive, that discount should disappear. So at least from the discount perspective, you will see some performance on the total return basis. And in addition, as the economy improves, as the REITs performance improves, you will have additional capital growth. So the market should rebound as soon as we go back to more normalized environment.
Thank you, Svitlana. I think we have just about a minute and a half left.
Yeah, just from my perspective, I would absolutely agree with that. Again, you look at a 3.8, talking U.S. listed equities here. You're looking at a 3.7% yield. You have consensus growth estimates on top of that of mid-single digit, with the opportunity for multiple expansion given they're so cheap on every metric. So, you know, getting to a double-digit return in a post-vaccinated world, we think is very possible. But again, I hate talking about the asset class because I just want to, again, underscore the point here of just the need to go active and the need to cast a wide net has never been more important. So it's increasingly more and more difficult to talk about real estate in such broad brush terms. But there's no doubt that there's real opportunity in real estate, and it's part of that real upside.
Great. Thank you very much. Barry, I think we might literally have 20 or 30 seconds left. So I would ask you, outside of technology, is there any one sector that you really think looks best convertible investors here?
Healthcare is a big element of convertibles, and it's a chronic growth area with the pandemic. And this seems to be a good background for healthcare. Indeed, our healthcare analyst is a medical doctor. It's one of our specialties, and we're very optimistic about it right now. We have lots of choices in the convertible market.
Great. Thank you, Barry. And thank you to all of you. I believe we'll be moving on to the next panel now.
Right.
Thank you.
Thank you.